Hello, this is Luke McCarty with McPherson Financial Group. Thank you for joining our first quarter 2022 update. And what a first quarter we had. We have the Fed raising interest rates. We have the bond market down 6%. We have the Russia-Ukraine situation. We have oil prices. We have inflation. There's a lot of headlines out there and a lot of negativity in the market. I'm going to dive into a little bit of what we look at when we make decisions on portfolios. And I'm going to show you some of the changes we've made along with our Q1 performance. All right, so what we usually look at from an economic standpoint are these indicators. The only negative indicator currently, and seems to be the recurring theme, is real personal income. I've been saying this for the last quarter, last probably half a year. If your income hasn't gone up by 8%, you have less money because inflation is 8%, or we could argue even higher. So real personal income is our only negative indicator right now. Housing starts, housing's doing really well, as we all know, even though we're now seeing mortgage rates. A 30-year mortgage rate has now hit 5% for the first time since, I believe, 2018. So housing's doing well. Retail sales is doing extremely well. One of our best performers in our model, Costco, is at all-time highs. We're looking at Target to potentially, add to the mix in the stock model. Civilian labor force is doing really well, and unemployment's under 4% still, and industrial production is still positive. So from the economy perspective, we do not see any recessionary indicators at the moment. Here's our annual performance. So the model at the top, our stock model, where we trade individual stocks, you can see on the far right there is negative 7.8% for the year. To add some perspective to that, through March 31st, the NASDAQ is down 11% and the S&P 500 is down about 6%. So we are aggressive. We own individual stocks. We are more diversified than the S&P 500. We own some international. We own mid cap, some small cap, quite a bit of technology stocks in there as well. So we're more correlated to the NASDAQ, which is down about 11%. Covered calls have performed well this year. That's where you get an enhanced dividend on about 20-25 blue chip stocks, 65 stock and 50 stock. This is where we start getting bonds and bond alternatives. And then equity income balanced is a strong performer too, where we own some short duration, high yield bonds. So these are the high yield bond that are getting hit really hard year to date on the negative side, but the short duration version of them owns the last 3 to 5 years of the bond. So you clip the coupon, but it's not as interest rate sensitive. So that model has held up extremely well for owning 50% fixed income, where fixed income as measured by the ETF AGG through March 31st is negative 5.8%. So some of the bonds, some bond markets are still working, but most of them are negative. And that's been the struggle for this year, is that everything essentially has been negative except for oil, energy, and commodities. Annual performance here on our ETF and mutual fund models. Our max growth model is down about 9%. And you can just go down the board there. What stands out to me, through Q1 of this year is balanced 50 all the way down to municipal income. They're all about the same. That's typically not the case. If you go further to the left, you are usually rewarded in balanced 50 for taking more risk than you are in conservative 30. But the issues, as I mentioned before, is that stocks are down, bonds are down. So fixed income in some of these models on the lower end, are negative. And you can see our multi-asset income model is negative as well. It's outperforming the benchmark, but it's still down over 5% for the year because fixed income and bonds and the interest rate sensitivity of the market right now is pretty volatile. These trends don't last for very long, but as soon as the Fed either continues to raise rates or doesn't raise rates more than the market expects. So what the market is expecting with these numbers we're seeing today, is the Fed getting, a little bit over 2%, 2 to 3% federal funds rate. If it stays around that, we shouldn't see fixed income continually slide. If they need to raise more because of inflation, it could become more of an issue on fixed income. Some of our portfolio changes, we established a new position into Griffin Institutional Real Estate Fund. This fund pays 5.2% dividend. We added that as a bond alternative. One thing to note here, from a municipal income standpoint, we added this to our models because 75% of that dividend is tax-free. In the world of real estate investing, you have quite a bit of depreciation, which offsets your income, making some of your dividends tax-free. We also opened a new position in the ETF GLD, which is gold. This went into all models except the income models because there's no income derived from gold. There's no dividends. There's no interest. It's price fluctuation. Here's a look at the institutional real estate fund. Now there's a lot going on this screen, but the far left shows you the exposure it has to different institutional funds. So this is a mutual fund that owns a lot of different investors and investment funds underneath it. You can see there in the middle, 74% of this fund is private real estate. So private real estate doesn't fluctuate as much as your public real estate and your public equities. So this adds a little more diversification, a little less market and interest rate sensitivity. And then on the far right, you can see the investments that are in here in the fund and their typical minimums to get into their funds. So by pooling together money by way of this mutual fund, it allows our clients to have institutional real estate that you would need a fund minimum, sometimes $1 million, $5 million, $10 million to buy into the fund. If you were to replicate this on your own, you can see there in the far right at the bottom, you would need over $179 million to buy into all of these funds in order to get the diversification that we have here. So this is very, very institutionalized, a lot of big money in play here. The gold ETF, GLD. So gold is broken above its 2011 peak and its most recent peak from August of 2020. So from 2011 till about 2018-19, gold was was on the downtrend, and then it roared back during COVID, and then it's been pretty flat since about August of 2020. But we're seeing it, break above this, get closer to 2,000 an ounce. And, we believe these extended periods of inflation are going to be bullish for gold. It has not worked this last year. So we think gold was taking a pause, consolidating a little bit. Now with all the geopolitical events and the, Russia, Ukraine, and Russia tying their, currency more to gold, we see more countries and institutions are buying up gold. So we opened a 3% position in most of our managed models. There's a lot of talk right now about the inverted yield curve. So a yield curve inversion occurs when the interest rate paid on short-term debt exceeds the interest rate paid on long-term debt of the same quality. Typically, when you hear about this in the news, they're talking about the 2-year versus the 10-year. So when the 2-year treasuries are paying more interest to you than a 10-year treasury, that's when it inverts. This happens when the Federal Reserve raises interest rates. And when interest rates rise in general, you get paid more for short-term than long-term. And it's kind of the opposite of what you would want, because you want to be paid more for your longer-term instruments than your short-term. This can be a recessionary indicator. It does not guarantee a recession is coming. And it also depends what yield curves you look at. So there at the bottom, all these yield curve talks are typically the 2 versus the 10, but look how many there are. There's 1, 2, 3, and 6 months. And there's 1, 2, 3, 5, 7, 10, 20, and 30 years. So you can kind of pick and choose what yield curves you want to look at. Some of them are inverted, some of them are not. Some of them are going in the opposite direction. And when we look at a big downturn in the market, I would say most, if not all of these would be inverted, not just the 2 versus the 10. Saying that, though, the 2-year and the 10-year did invert on April 1st of this year. Below is the last 4 times this occurred and how the S&P 500 index performed. So 1988, 98, 2005, and 2019. These were all periods of rising interest rates. Most recently in 2019, the Fed was raising interest rates all the way up until about Christmas Eve. And they said, okay, we're done raising rates. And then, the markets did well. And you can see here where the peak of the market was and how long until the peak of the market. and the average rate of return during that time frame was about 28%. So the yield curve inversion does not guarantee a recession, but if there is a recession following, it's typically within 17 months of the inverted yield curve. I believe what happened in 19 and 20 was more in lines of COVID, right? That the economy was doing very strong, and then COVID came. So that inverted yield curve may not have played out to a recession. However, we had a very quick recession with COVID until the Federal Reserve jumped in and spent trillions of dollars. Now we're at $30 trillion of debt. So don't believe all the news and all the hype you hear about the yield curve. We're watching it. We're watching more than just the twos and the tens. And we have a way to track that and kind of see where we're going to end up and how the economy is performing. Thank you for watching this update. Once again, this is Luke McCarty at McPherson Financial Group. Email me. There's Art's email, our office line, and there are our required disclosures.